Good day and welcome to the Baazar Style Limited Q1 FY2025 earnings conference call. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Saman from Stellar IR Advisors. Thank you and over to you, sir.
Good evening everyone and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Shreyansh Surana, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. The management will be sharing operating and financial highlights for the quarter ended June 30, 2024, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon our beliefs, opinions and expectations as of today. Statements are not a guarantee of our future performance and involve risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Shreyansh Surana. Thank you and over to you, sir.
So hello everyone, good afternoon. I welcome you to the middle earning call of Baazar Style Retail Limited to discuss Q1 25 performance. I am delighted to speak to you all for the first time after a successful listing. I hope you have all gone through the results and the investor presentation, which is available on the stock exchange and on our website. As this is our first earning call, I would like to take a few minutes to take you through our business model and the journey we have undertaken so far. With the thought of revamping India's wardrobe and fueling the economy, Baazar Style started in 2013 to cater the aspirational needs of real Bharat, that is Tier 2, Tier 3, Tier 4 towns of the country. And while doing that, we became one of the fastest and the largest growing value fashion retailer, both in terms of store count and revenue from operation. We started our journey in 2013 from a small store in Berhampur, followed by 184 stores as on 30th September, with a retail space of around 16.66 million square feet across 158 cities. With an employee strength of around 2,600 plus people, an office space of around 30,000 square feet, and a warehouse of around 1.8 lakh square feet, we aspire to reach the zenith of fashion evolution in next 5 years. In terms of product offering, we have got it all covered under the banner of Style Baazar, from stylish menswear to elegant women's wear to adorable kids wear and all household related articles, plastic wear, toys, etc. In the last 12 years, we have made Bharat stylish and aspire to keep up with the trend in future also. In 2013, we embarked on a journey of growth and innovation when we opened our first store in Berhampur, West Bengal. A humble beginning that set the stage for our future. By 2016, our expansion continued as we opened our maiden store in Odisha. That year, we celebrated crossing an aggregate of 0.10 million square feet of retail space with our revenue soaring past 100 crores. With a solidified presence in East India, the year 2018 marked a significant milestone as we raised funds from late Rakesh Jhuwala, Intensive Fiscal Private Limited and other marquee investors. The support enabled us to launch stores in different geographies, doubling our store count to 72 stores in 2019, and we crossed the revenue of 500 crores in 2019, FY 2019. Fast forward to 2024, we have now crossed an aggregate of 1.4 million square feet with a presence of 162 stores across 9 states, paving the way for an even stronger market presence. In Q1 FY25, we opened 4 new stores in Assam and Bengal, taking the total store count to 166. And as on 30th September, we have got 184 stores across 9 states and 158 cities. Our greatest strength lies in our cluster-based strategy for rapid store expansion. This is one of the key strengths and strategy for the company, which has allowed company to deeply understand the local areas, adapt to their customer preference, and enhance brand visibility. The power of clusters has also helped us to optimize marketing expenditure and supply chain expenditure, and also optimize on the inventory side. In terms of market, we have got 2 markets. One is core market states and one is the focus states. So primarily West Bengal, Assam, Bihar, Odisha are our core states, and where we have a decent presence. And the focus states are the growing states like Tripura, Jharkhand, UP, Andhra Pradesh, and Chhattisgarh. Our goal is to bridge gaps in untapped areas of the core market while also exploring the new territories in both core and focus market. This approach enables us to stay competitive and achieve the best possible results both in terms of profitability and revenue. In terms of product, having a deep understanding of customer preference allows us to curate a comprehensive and a targeted product mix that resonates with our audience. By analyzing the trends and feedback from our customers, we can offer a diverse range of products that meet the varying needs and desire of our customers, ensuring that they find exactly what they are looking for. Our product range includes fashion apparel for men's, women's, kids, athleisure, bottom wear, ethnic wear, night wear, and wearables. Then there is a general merchandise which includes home decor, household products, home furnishing, home appliances, and accessories, that is bags, travel, accessories, lifestyle products, and footwear. We strive to create a one-stop family shopping experience where customer can find everything that they need under the one roof for the entire family. By combining quality products with affordable pricing, we make shopping convenient and enjoyable for our customers, ultimately leading to increased satisfaction and loyalty. This approach positions us as a go-to destination for families, encouraging repeat visits and long-term relationship built on trust and value. Coming to share a little more details on the private label, we have got 10 private labels, that is Square Up for men's and boys wear, Wolsey and Cutter again into the men's apparel, Avaya is for the ladies ethnic wear. Square Up is one of the largest brands that we have in the private label, which stands at 117 crores of revenue as on FY24. From FY20 to FY24, our private label segment has experienced impressive growth of approximately 64.6%, contributing to 38% of our overall revenue. These have also enabled us to achieve better profit margins. In terms of growth strategies for the future, as you can see that the market is big enough. As per Technopack report the North and the East region market share for value retail is expected to grow from 3,09,000 crores in FY24 to 4.58 lakh crore in FY27, which is a CAGR of 15%. To build on this ever-growing industry demand, we have some strategies in place to add our growth. We aim to expand our store count further through deeper penetration in core markets and forming new clusters in focus market to our strengthened market positions. We would like to continue to invest in strengthening our supply chain management and human capital to further reduce our operating costs to further optimize our supply chain management. The intent is also to focus towards creating differentiation and achieving greater control over the product quality through private labels. This fosters a sense of trust and loyalty among our consumers. Also, we continue to improve our operational efficiency through investment in technology, adoption initiatives, data analytical capabilities, and implementation of an omni-channel retailing business model. With that, I would like to conclude my opening remarks and request our CFO, Mr. Nitin Singhania, to take over to explain the financials.
Thank you, Shansi. Good evening, everyone. Now I will begin by sharing operational highlights and key financials numbers for the quarter ended on June 30th, 2024. Starting with the financials for Q1 FY25, the total income at 279 CR was up 22% Y-on-Y and 24% quarter-on-quarter. Gross profit at 91 CR, up 22% Y-on-Y and 25% quarter-on-quarter. EBITDA at 42 CR, up 23% Y-on-Y and 78% quarter-on-quarter. EBITDA margin at 15.2%, up by 20 BPS Y-on-Y and 460 BPS quarter-on-quarter. PBT at 11 CR, up 33% Y-on-Y and 215% quarter-on-quarter. Loss after tax at 0.4 crore impacted due to exceptional loss on account of provision of loss of 11 CR due to fire in one of the warehouse and insurance claim still awaited. Coming to the key financials metrics, in Q1 FY25, we continue to witness healthy volume growth overall and strong growth in private label sales. The private label's contribution increased from 37% in Q1 FY24 to 52% in Q1 FY25. In absolute term, it is at 145 CR, up 70% Y-on-Y. The store count grew 19% Y-on-Y to 166. The rental area of the stores grew 15% Y-on-Y to 1.05 million square feet. The average store size in square feet stood at 9,032. The total number of bills grew 27% Y-on-Y to 3.08 millions. The quantities sold grew 20% Y-on-Y to 10.29 millions. The average transactions value stood at 949. Same store sales growth stood at 5.5%. As we speak, for FY25, which is also available in public domain, some key highlights are revenue grown by 65% Y-on-Y to 311 CR in Q2 FY25 and 41% Y-on-Y to 586 crore in H1 FY25. Sales per square feet stood at 708 per month in Q2 FY25 and SSG at 41% in Q2 FY25 and 21% in H1 FY25. Total number of stores stood at 184 as of 30th September 2024. The company opened a total of 21 new stores and closed 3 stores during the quarter FY25. In addition, over the past year, revenue grew at a CAGR of 33% to 973 crore in FY24, gross profit at 36% CAGR to 326 crore, forming a healthy gross margin of 33.5%, EBITDA at 44% CAGR to 142 CR with an EBITDA margin expansion of 220 BPS to 14.6 in FY24. Profit after tax has improved multifold to rupees PAT 22 crore from 5 crore. We have a healthy return ratio with ROCE at 18% and ROE at 11%. To this note, now I conclude our presentation. We will endeavor to continue with this growth momentum going forward. We thank you a lot for listening us affirmatively, and now we open the session for question and answer to you all. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arpit Shah from Stallion Assets. Please go ahead.
Hello.
Yes.
Am I audible?
Yes.
Yeah, congratulations on very good set of numbers for H1 FY25. I had a couple of questions. If you can just walk us around the unit economics of a store. What is the payback like? What is the ROC like? And how does the unit economics work in terms of sales per square feet, cost per square feet, gross margins and everything? That would be my number one question. Number two question would be around seasonality of the business. What is Q1, Q2, Q3, Q4 typically as percentage of saliency in terms of sales? So that if you can add in that number. And any guidance you all are sharing for PAT or revenue for FY25 and FY26, because since we have seen a very, very strong H1 FY25 with almost 41% growth. So what kind of numbers can we see for FY25? And even your competition has also reported good set of numbers, be it B2 retail or V-Mart. Is there a large change happening on the ground for tier 2, tier 1 kind of economies where the demand actually starts picking up, or is there a seasonality factor in play for other peers and as you as well?
So answering to your first questions about the store unit economics. So typically, if we see in store size of 7,500 square feet, so sales per square feet is around 7,500 square feet with an store EBITDA pre-Ind AS at 13%, which will come out to be 7.34 million. And if we take the capex of only capex, the payback period will be around 16 to 18 months. So capex investment is around 1 CR, and with inventory it will be around 2 CR, and it will be between the payback period including inventory will be 31 to 36 months.
Sorry, the capex is 1 crore and inventory is 2 crores. So 1 plus 2 crores, 3 crores, right?
No. Capex is 1 crore and 1 crore is the investment on inventory.
Total capex is 2 crores and 75 is it, let's say the average store size, you will be spending about, you said your sales per square feet is 7,500 rupees, right?
Yeah, 7,500 to 7,800.
And what will be the gross margin?
Gross margin will be around 33.5, which was already there in for FY24. So 33.5% gross margin.
And how do we walk down in terms of operating costs and everything?
Operating cost generally lies between, including rental, it lies between 20 to 23%.
20 to 23% is our operating cost.
On pre-Ind AS.
Pre-Ind AS, got it. And your payback is 31 to 36 months, including inventory.
Yes.
Got it. If you can just help me with the seasonality of the business.
Yeah, hi. Thank you for your question. In terms of seasonality now, because we are a Eastern India brand and there are lots of festivals in the East India, so there is a seasonality factor in the growth. If I tell you about last year, so in last year the Durga Puja, which stands at October 23rd last year, and which is right now on 13th October, so the 10-day seasonality factor is in this quarter in terms of growth, which cannot be quantified. But yeah, that's the regular practice which comes always sometimes in this quarter and sometimes in the third quarter. Coming to your question in terms of revenue, so the first half generally tends to have 43 to 48% of the revenue, depending on the seasonality.
43 to 48%.
Yeah, the first half.
Got it. And what should be the PAT guidance for FY25, the revenue guidance?
It will be between 3.5 to 4% before exceptional loss.
At pre-Ind AS levels. And in terms of revenue growth, our guidance would be around 25%.
So around 1,250 crores is the sales number that you're estimating. With that, the pre-Ind AS PAT would be around 47 crores, broadly, 47 to 50 crores.
Yeah, pre-Ind AS.
The percentage that we are projecting.
Yeah.
And the Ind AS PAT would be how much?
Between 2.5 to 3%.
And what was the pre-Ind AS number for FY24?
Pre-Ind AS numbers for at EBITDA level for FY24 was 7.4%.
Now, what is the PAT number pre-Ind AS FY24?
Sir, it is 2.23. Ind AS is 3.03. Sorry, 3.03. 29 CR.
At pre-Ind AS.
At pre-Ind AS.
Got it. And you see an impact of Navratri in Q3, right? Q2 did not. What was the reason for jump in Q2 revenues for across the sector, be it V2 retailer, V-Mart or anything?
I think there are lots of things which is happening in tier 2, tier 3, tier 4 towns. According to me, if you ask me, I think there's a huge shift coming from unorganized to the organized market. We are seeing a lot of traction coming from that particular space. Apart from that, with the scale, we have built our team that way in terms of merchandising, in terms of designing, in terms of price positioning. I think all these factors are leading to this growth. It's just not the seasonal situation that has led to this much growth. Otherwise, also if you see for the entire half yearly, it's 41%. The growth is in 41%. So there are lots of customers flowing from unorganized to the organized market.
Got it. So even Q3 we'll be able to see some quarter-on-quarter growth, right? Given that we are seeing a very strong attraction of customers and footfall. So is it good enough to estimate Q3 is also we're going to see a quarter-on-quarter growth?
See, I can just tell you about for the full year. As I said, the 25% will be the growth that we will be chasing for this entire financial year. And there are lots of festivals both in Q2 and Q3. Q3 has got lot of festivals. So that can only I can share right now on the call.
Sure. Thank you so much, Mr.
Thank you. The next question is from the line of Chintan Shah from JM Financial Family Office. Please go ahead.
Hi, thank you so much for the opportunity. The first question is more in terms of strategy. So we understand that we are more present in tier 3 and 4 towns, that also in the eastern region. So wanted to understand what is the potential in terms of revenue per square feet that we can drive over the next 2-3 years, and what initiatives we are taking to improve this, or the any trends that are playing out that is helping us to reach there. So what's the potential that I want to understand?
See, in terms of potential, the East India has got a lot of potential. As I already said, that 3,09,000 crores is the market cap as of now on the value fashion retailing as on FY24, which is supposed to be at 15% CAGR. And in that too, also the unorganized penetration, the organized penetration is very less, and the people are moving from unorganized to the organized, or the consumers, which is helping us to have this growth. Now coming to the question in terms of sales per square feet, in our model, what we do is that in terms of tier 2, tier 3, when we open a store, it's more about EBITDA per square feet than the sales per square feet that we take as a benchmark. Because in tier 2, tier 3, the rentals are comparatively very low than tier 1 and metro cities. And that is why the metro and tier 1 will have a higher sales per square feet compared to tier 3 and tier 4. But the EBITDA percentage would be higher in tier 3, tier 4 compared to the metro and tier 1. So it is very subjective depending on the site that we are opening. And the strategy for going forward will be that's cluster-based approach only. So we will be keep focusing on these 9 states that we are in. Apart from that, if there is any extension to these states, for example, if there is a store that we have to open in the northeast part, we would like to go over there. There is no issues in that because the assortment that we are planning, it will be suiting that particular region also. The intent will be to grow in the existing region itself.
Okay, got it. Understood. And secondly, I wanted to understand in terms of competitive intensity in other areas that we are present in. So in terms of organized retail, how do you see the competition shaping up? And also more specifically, just wanted to understand if Zudio is present say, in any of the regions or and if you've seen any impact or traction from there, if you can help us understand.
So in terms of geographical presence, we have got lots of stores where areas where the Zudio is also present. But I think the market is big enough for everyone to stay, and there are lots of difference between us and Zudio also. Zudio is targeting majorly Gen Z consumer and focusing on everyday wear. We are more like a family-oriented shopping, where you can get ethnic also in our stores for the ladies. You can get kids collection also in the stores, which primarily Zudio doesn't offer. So as a result, we both coexist there are lots of places and where we both are doing good, both in terms of revenue and in profitability, and that's that so.
So is it fair to say we haven't lost any business because of say Zudio being present in our region?
Yeah, we haven't. Because see, what we do is that now whenever we open a store in a cluster-based approach, we try to understand the consumer preference and we try to create the assortment as per their festival needs. Whereas the Zudio model is like a day-to-day wear articles, more focusing on Gen Z, which is below 30 years of age, and our target is to cater the entire family. So we have got all the product ranging from ethnic section to a formal shirts category to a festive wear articles. So I think that is the difference between us and Zudio. And specifically the kids, for example, there is no kids wear in Zudio.
Okay, got it. And so just one last question from my side. So if you see the Q1 numbers, so the private label mix has grown from say 37% last year to somewhere around 52%. And ideally, I believe this should be margin accretive. But if I see the Q1 numbers, our margin is similar to what we reported in last year's quarter. So if you can understand why has this happened?
So basically, it's a pure strategical call that we have taken because we want to establish our private label brands in the market, and we have gone for an aggressive pricing on that structure. So we want to. That's why we have increased it from 38 to 50, around 52% in the Q1. and the guidance for this year will be also to go, the range will be 45 to 50%. So we want to expand our private label share, and we want every consumer to take the private label articles and to experience that article, and next time when they come, they ask for that article itself in the store.
Okay, got it. So
After that also we have the 0.2 basis % has been an increase in the gross margin from last quarter.
okay, so from a long-term perspective, what sort of mix we are looking at from private labels, and if you can also help us if they're going to go aggressive in pricing. So in terms of margins, basically, what would be a guidance for the 2-3 year perspective?
So in terms of margin, our margin will range from 33 to 34% for the entire financial year.
Okay.
And the guidance for the private label contribution will be between 45 to 50% for the entire financial year. FY25.
Okay, fine. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Kapil Jagasia from Trust Mutual Fund. Please go ahead.
I hope I'm audible.
Yes, sir, you're audible.
Yeah. Couple of questions from my side. How much these core and focus states would be growing for you, and what would be the trajectory going ahead? That would be the first question. And second question would be this accidental fire event. Any reason for this non-intimation? Because during the IPO, this thing was not mentioned. And any spillover of this event on earnings for Q2?
Sir, regarding warehouse fire, the same was disclosed under the risk factor in the offer document, where we have said that 50 crore of inventory was burnt out and 8 crore of PPE was also, we haven't loss of that. So that was covered in the offer document. And regarding that, we have taken 10.76 as the exceptional loss, being keeping prudence in mind. So our stat auditor has also suggested that we should take the loss which are not covered by the insurance company. So as in prudence, we have taken this into accounts.
Okay. And any spillover seen in this Q2 quarter?
Regarding the revenue as something?
No, in terms of provision or anything would be there in Q2, or everything is covered in Q1?
Everything has been covered in Q1.
Sure.
And in terms of core and focus that you asked, so in terms of focus test for Q4 FY24, we had 33 stores, and for FY24 we were at 121 stores. Am I audible?
Yes, and how they would be growing separately, the core stores growth and the focus stores?
Basically, the focus will be to grow core at a higher level where we are present. The states like Bengal, Assam, Orissa, and Bihar, and the focus states majorly is UP and Jharkhand, which is a growing state for us. So I think the ratio typically you can say is that around 70% stores are typically gets opened in the core and 30% in the focus.
Right. So the mix would be kind of similar for the whole of FY25?
Yeah, you can assume so.
Sure. And how much would be the full price sales for us with this private label contribution going up? Would we be seeing this contribution also increasing?
So for FY24, it stands at around 86% of the sales came from the full price sales through for FY24, and I think we intend to maintain the same rate for this year also. Little bit on the better side, you can say.
Sure. That's it from my side. Thank you so much.
Thank you.
The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Hope I'm audible.
I would request you to please use your handset.
Yeah. So congratulations for a good set of numbers, and thank you for the opportunity. So my first question is on a store count. So how do you see store count panning out in, say, next 2-3 years?
So on an average, we would like to grow between the range of 40 to 50 stores every year.
Okay. And in terms of gross margin, do you plan to maintain the similar gross margin for upcoming years also?
For this year, the guidance would be between 33 to 34, and on the coming years, there will be a little increase in the margins.
Okay. And so my next, most of my, all my doubts have been answered. So yeah, that's it from my side.
Thank you.
Thank you. The next question is from the line of Raj Shah from Ambit Asset Management. Please go ahead.
Thank you for the opportunity. So I wanted to understand how is our...
interrupt you, sir. May I request you to please use your handset?
hello, can you hear me now?
Yes, sir. Please go ahead.
I wanted to understand what is our inventory policy, like what is the average number of inventory days we hold, and if suppose any merchandise gets around 2 to 3 months old, what is the discounting that we take?
So generally, as on 30th June as we speak now, our inventory days are 120 days on sales, and generally we have a policy in which we try to liquidate the inventory during the end of season sale. That is why over 86% of the sales comes from the full price sale through.
Okay. And from the IPO process, like what kind of debt reduction would we see going forward, and how much of this capital would be used for store expansion?
So, as you see the offer document, 146 crore was intended to repay our debts, and balance was to improve the working capital or for growth strategy. So as of Q1 FY25, the total bank borrowings was 153, and with the offer proceed, we will intend to reduce it further.
Okay. And just a last question. So, in terms of new designs, so in every season, what kind of new designs do we take, and what is the average period of design conceptualization to reaching the shelf?
So it's a period of 6 to 9 months typically. So for any season, the designer and the merchandiser both work with the manufacturer. They curate what is the trend that is going to be coming which is going to be for the next season. They create a mood board, and depending on that, they curate all the articles range and they showcase their presentation, and then the product is selected. So typically end to end, from designing to giving order to the vendors and to the delivery, it is a cycle of 6 to 9 months.
Okay. And what percentage would be in-house designing?
So basically, we have got in-house 57 people team, including the designers, quality checks, and the merchandiser, who sits together and they work together on the design part and on the different merchandising part. And with the help of manufacturer, they curate those designs and their articles.
So everything is designed in-house?
No, see, basically it doesn't work exactly in terms of designing. So there are lots of times it's only a fabric. When you play in garments now, it's not only a design part. So when the fabricator shows you different fabrics, that this is the fabric, for example, this is a floral prints that is going into this particular summer season, and this is the color combination of pastel shades which is going to be very hit for the trend. So the merchandiser's role is to select from those fabrics, and on those fabrics they try to play it on, because we are a value fashion retailer, so it's more of a fast fashion.
Okay.
On that particular fabric they conceptualize and design.
Understood. Okay. Thank you so much.
Thank you. The next question is from the line of Abhishek from AB Capital. Please go ahead.
Hello, can you hear me?
Yes, sir.
Yeah, you're audible.
Yeah. What will be the ROE trajectory going forward?
ROE?
Yes.
So ROE in FY24 we had 11%, right? And going forward we will intend to be in between 11 to 13%.
Okay. And what will be the sales growth going forward?
So last year FY24 we did 9.54% as the SSG growth, and this year we started with the guidance of 8%. But the way we are seeing the traction coming from all the geographies, we have increased our guidance from 8 and we have changed it to 9 to 10% will be the guidance for this entire financial year in terms of SSG. And as on 30th September, as we speak, our SSG stands at 41%, please.
Okay. Thank you.
Thank you. The next question is from the line of Pratik Giri from Shubh Labh Research. Please go ahead.
Sir, am I audible?
Yes, sir.
Thank you for confirming. Mr. Surana, congratulations on successful listing, and thank you for giving me this opportunity. Mr. Surana, 2-3 questions from my side. First one is, we have already seen, around 15-20 stores being opened during this IPO process. How many more store addition do we see in FY25? And of what typical size we are planning this store addition in? And just one more in this is, how much time does it take for us to turn EBITDA positive on a store level after we open a new store? This is the first question.
So in terms of store expansion, 35 to the 40 stores are that we are targeting for this under the financial year, FY25. And in terms of store EBITDA, you can say that because we are in this value fashion retailing and we are primarily into this festive economy, generally on an average, for the entire financial year, the any store which opens into a particular financial year, it gets the operational EBITDA positive in that particular year itself. So from the first year itself, it's a EBITDA positive store for us.
Got it. So you mean in FY25 there is to be around 20 more stores to be open? And within 1 year, our stores turn EBITDA positive, correct?
Correct.
Understood. Mr. Surana, my second question is on the growth roadmap for next 3 to 5 years. If you can allude, what is the North Star we have set for ourselves? We are already around 185 stores. And what is the plan for, say, next 3 to 5 years in terms of number of stores? Where do you want to reach in that KPI?
So we intend to double our store count on next 3 years.
Okay. Understood. Anything further you would like to add on profitability or something? Because, growth definitely will come with incremental stores. But guarding the profitability, any thoughts on that?
I think, in terms of profitability, we are right now also, if you see in terms of profitability, we are at at pre-Ind AS level. We are at 3 Ind AS levels. We are already for FY24 at 3%, and for FY25 our guidance will be between 3.5 to 4%, and our target is to reach to a profitability target of 4 to 5%, maybe in 2 years' time. Suppose that we would like to give all the entire extra profit that whatever we earn to the consumers themselves itself, so that we can have a higher command over the product and the consumer section that we are dealing in.
Understood. Very helpful. The second question is, the third question is on the inventory management side. Probably what we have is something around 2.5 to 2.6 tons, whereas a few other people in the industry are doing a number which is higher than this. So how would you look at this KPI? Is there a incremental scope of turning the inventory more number of times, generating more profits from that same capital? Any thoughts on that? And yes, additionally, sorry to interrupt, Mr. Surana.
Please go ahead with your question.
Yeah. The role of technology in this, because we have retailers in India who have been doing phenomenal job in inventory terms and generating profits from that. So how do you look at the role of technology in this and your target for inventory terms?
So coming to the first question, in terms of inventory now, because we are East India player now, so typically the 31st March and 30th September for us looks very higher on the inventory because of some festivals going in the month of April and October, which is not a correct inventory for the entire year that way. And second thing is because we are a growing company and the annualized sale has not been taken in account, but the inventory has been taken in the account. So as a result, inventory days looks little higher, but that's not the actual picture for the actual picture. And coming to your second question regarding that Technology, yeah, we are investing heavily in the technology. So we have just created an ultra modern facility in our warehouse, which is of 1.8 lakh square feet. And we are trying to reduce the timeline between the store supply from warehouse to store, because we are seeing that the faster you supply to the store, higher will be the sales achieved in the store, and higher will be the turn, lower will be the aging inventory. Plus, the experience that we are getting when we are entering into a geography, where after spending 3-4 years in the geography, in terms of cluster-based approach that we are following, we tend to understand what is selling and what is not selling. So I think all this combined knowledge, we are putting it in our on the tech part. We are building that logic and algorithm, which is helping us to improve inventory turn in stores also.
Understood. 30th September, so the September balance sheet will be published.
May I request you to please rejoin the queue for your follow-up question?
Ma'am, this was just a clarification, if you may allow.
Okay.
I was just asking, the 30th September balance sheet number will be a fair figure, sir?
Correct. So the 30th September and 31st March will be on the higher side in terms of inventory weightage, because of our seasonality factor.
Okay, so you're saying both the dates will have heavy inventory in the balance sheet?
Correct.
Okay. Thank you. I'll join back the queue. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Raj from Arjav Partners. Please go ahead.
Am I audible?
Yes, sir, you're audible.
So you have guided for 25% sales growth, right?
Correct.
So you will be going around 1250 to 1300 crore range for full year FY25.
So for us, the guidance is around 25%, which is around 1220 crores from 973 crores, 1216 crores to be precise. The guidance that we have given.
All right. And sir, you guided for PAT growth, PAT of around 3.5%, right? 3.5 to 4%.
On pre-Ind AS levels, excluding exceptional losses.
Sorry?
Excluding exceptional losses.
Excluding exceptional losses, all right. So, hello?
Yeah, you're audible.
When we say pre-Ind AS, so what exactly do we mean pre-Ind AS and post-Ind AS?
So we are taking rental into account while calculating pre-Ind AS. It is as per IGAAP, and Ind AS is as per accounting standard.
So basically what happens is that now in terms of rentals, the rentals are discounted at a banking rate, which increases the interest cost on the financial portion in terms of Ind AS, which is the accounting standard that we follow for the listed entities, and in which we provide our result. But on the IGAAP section, the PAT tends to be on higher side than at the Ind AS level, because of the actual booking of the rentals.
So, what you are trying to say, post-Ind AS PAT would be lower, right?
Yes, as per Ind AS, it will be lower.
All right. So, how much of PAT are we expecting as per Ind AS?
As per it will range between 2.5 to 3.
2.5 to 3%.
Yeah, before exceptional losses.
All right. So, we are expecting a PAT of around 35-40 crores, I guess.
Yeah.
All right. And sir, if I look at your inventory, if I look at the trade payables, the trade payable days for FY21 around 121.
Yeah.
Do we expect FY25 payable days also to be in the similar range?
No. With this will be on a decreasing trend, because post of IPO, so we will be having ample cash flow, so to reduce our trade payable days.
Okay. And how much of these trade payables are to our related?
So in totality, FY24, the 3.36% was the percentage of total data by transaction that has been done for the year.
If I see your the payables around 262 crores, right, for FY24 end?
Yeah.
So how much of these 262 crores belong to related parties?
This number is not handy right now, but as I said, in terms of percentage, 3.36% is the total buying that has been done last year with the related party.
All right. Yeah. And sir, one more thing I am intending to ask. You have given a business update for Q2 FY25, right? So looking at the update, I feel that the guidance which you have given is a bit on a conservative side. Realistically, you would be able to grow slightly higher than the guided figure of 25%, I think.
I think if that's the case, that's good for the company. But yeah, we want to take a prudence approach in that, and we would like to stick with this guidance only right now.
All right. And sir, you also said you wanted to have a PAT of around 4 to 5% over next 2 years' time. So is this PAT of 4 to 5% pre-Ind AS or post-Ind AS, you have said?
So it is PAT of pre-Ind AS, post-Ind AS, 4 to 5%.
Post-Ind AS, right? All right. Thank you.
Thank you. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, thanks for that. My question got answered. Thank you very much.
Thank you. The next question is from the line of Abhishek Kumar from Sanctum Wealth. Please go ahead.
Hi, good evening. Congratulations on the good set of numbers. My question was first on your strategy on focus states, given that majority 80% of the states, 80% of our store count currently are in core states, and as I heard you well, that 70% of the new stores will be in the core states, and the rest 30% will be in focus states. So, what exactly will be the strategy going forward for focus states? Because as I see, UP and Jharkhand are relatively bigger, and especially UP given the size. So, what exactly is the strategy over there? That's my first question.
So in the study, as another ratio will be 70:30 also, till the store becomes the focus states becomes into core states. So typically for the next 2 years, the strategy will be simple: 70% will be in the core and 30% will be in the focus states. It is a number of stores that we are going to open.
Okay. And one more question I had with respect to the store size. So I can see the store size as like the size is reduced. So is it like a temporary thing, or what exactly is the reason behind it, or are we kind of recalibrating our store sizes or the new stores which we are opening?
Actually, it depends on generally we are opening in tier 2, tier 3, tier 4 cities now, so we have reduced the store size to optimize the level in terms of sales. And whenever we are opening the cities also, sometimes the stores that we are getting is at a lower size. That is why end to end the store size looks on an average around 8,000 square feet that we are opening.
Okay. And we have only one kind of format, right? Or are there like more than one kind of format of stores? Like a smaller store or a large format store, or blanket only one kind of store format is there?
There is no such as format. So typically, the lowest store that we have is got around 4,000 square feet, and the largest is around 28,000 square feet in terms of retail area.
Okay.
So depending on the store size, we curate the assortment.
Okay, and there where you have just say example, if in a particular area you have a bigger size format store, so around that you will build like a smaller one, right?
I didn't get your question. Can you come again?
So, which are particularly the areas where you decide upon opening like a bigger size store compared to a smaller one? Which are locations or cities? What exactly are the reasons behind it?
Generally, it's a metro and a tier 1 cities where we decide. And again, it totally depends on the site. For example, if we are only one over there and we see a lot of potential in the market, and we get that size. Actually, such a big size is also a very difficult task. On an average, you generally get 8,000 square feet stores only across. So 90% stores typically will be around 8,000 only that you get. There will be 10% stores, but if there's a market potential, we tend to take bigger stores also.
Okay, got it. And my last question was on the fire incident which occurred in the warehouse. So, what exactly happened and what measures you as a company are going to take in order to avoid such incidents going forward, given that we are on a high growth trajectory and we are a growing company and we wouldn't want these kind of situations to come. So could you give your take on this?
So actually the fire broke out in the nearby warehouse, and through which it traveled to our warehouse. And in order to we have taken all the measures that we can take on the fire part. Even in the new warehouse, we have created all the modern equipments that we have given. But again, saying to that, the first thing that we have did is that we have tried to separate our warehouse from the other warehouse. We are not keeping it on a one boundary wall going forward.
What is
which was our learning from this fire.
Okay. Yeah. Thank you.
Thank you. The next question is from the line of Yash Sanatria from Buoyant Capital. Please go ahead.
Hi. Thanks for the opportunity and congratulations for good set of numbers. So my first question is, sorry if I'm asking this again, but can you help me understand how much of your inventory will be more than 1 year older and how we plan to discount it, like how the discounting works in our store?
In terms of percentage, we generally don't mention it, but the way we discount is that we have a policy, internal policy with the operation team and the merchandising team, in which they have a product lifecycle management system through which they try to gauge which is a moving and non-moving inventory, and accordingly they plan a discount on that. And typically our average ASP is also very low, so while giving a little discount also we are able to liquidate more on the inventory side.
Got it. And what is the number for more than 1 year older inventory? Sorry?
So, cannot comment on that right now.
Okay, got it. And like our revenue per store or revenue per square feet is still quite lower from some of our peers. So is it because of the higher mix of new stores, or is it because of different strategies or the ASPs, and what do you think it is? Or
it is generally lower because of the strategy for tier 3. So we have a higher presence in tier 3 and tier 4 cities, where we generally tend to take a building that we have taken. As a result, the rentals are very low, so EBITDA is very good, but SPSF looks lower on those areas.
Got it. And like in last few years, all the companies in the industry has grown well, and now everyone is having the ambition to grow by 40-50 stores a year. So will it impact structurally on revenue per store or square feet for all the companies, because then everyone will be entering each other's states or cities or towns? So
I will tell you, the market is big enough for everyone, because right now also if I see now, the most of the places where we are in tier 2, tier 3, there are only 2 to 3 stores, organized level stores right now. And the major part of chunk is still going to the unorganized market. And as the market expand, I think the way we are seeing a traction, huge traction is coming from unorganized to the organized section. So there is enough room for everyone to stay. Yeah, but the people who will invest in technology, who will invest in the process, I think they tend to grow, will be able to sustainably grow the number of store counts, because retail is very simple that way. It's not nothing out of box, but you have to have a strong processes and investment in technology to grow sustainably.
Got it. Thanks for answering all the questions. That's all from my side. Best of luck.
Thank you. The next question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi sir, thanks for taking my question. Congrats on a very good set of numbers. So my question is on the geographic concentration that we have. So almost 50% of our revenue is concentrated to West Bengal. So any thoughts on or strategies on reducing that concentration of revenue? And where do we see this going forward in say 2 to 3 years? Is it going to come down or is it going to remain the same?
So gradually as we are entering into the newer territories in the focus markets also, and even in the core markets. So from whether it was very high in last 3-4 years ago, right now it has reduced substantially very low. And as we speak, the concentration on the Bengal side as an FY24 is around 45% revenue coming from the Bengal, but it will reduce in the near time also, in the next 2-3 years.
Yeah.
And in the Q1 FY25, 42% of the revenues come from Bengal.
Okay, got it. And my second question is, sir, if you could give a little more color in the light that 45% of revenue is concentrated to West Bengal, and the Durga Puja season is probably 10 days earlier this time. So how will that affect us going into Q3, and if you could give some color on that?
As I said, for the entire financial year, as I said, the 25 will be the guidance. And right now I cannot comment on the quarter 3 because it's a Q1 business update. But the flavor will be around 25% in terms of calculation. You can count that way, how much it will be.
Okay, sure, got it. Thank you. That's all for answer.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Suresh Samant for closing comments.
Conference. Thank you for joining us today. Please feel free to reach out to Stellar IR advisors in case of any queries. Thank you.
On behalf of Baazar Style Retail Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.